Hey, good morning, everybody. Thank you for attending today's webinar. My name is TJ Jones. I'm a Life Marketing Director here at Insurance Agency Marketing Services, joined by Andy Backegard with North American. And today he'll be discussing with us another concept in our business concept series. We'll be going over retirement planning strategies for the business owner. So I'll get us started here with a few quick intro slides, as we always do. Just want to remind folks, if you're not muted, if you could mute your mics, that'd be great. I'll buzz through these and we'll get to the meat of the presentation. If you have any questions that I can answer or Andy can answer, please type them in the question box, and we'll get to those as soon as we can. All right, I'll get us started. First, I want to talk about a couple of business builder programs that we offer here at Insurance Agency Marketing Services. First would be our Referred Producer Program. So when you, as a contracted producer with us, refer a contact to us, and that referral contracts with us just for the contract, we'll cut you a check for $50. Once that referral actually submits a piece of business with us, it's a $100 additional $100 check to you, and then 20 basis points on any business written by your referral thereafter. So a great opportunity to kind of build a team of referrals where you can make some additional cash. We also have our marketing reimbursement program. For every $100,000 in premium that you submit with us, whether that's single premium life or annuity premium, we submit a $200 real cash into a marketing reimbursement account, and out of that account we pay for 50% of your submitted business expenses. Those can range from purchasing leads, if you purchase leads, monthly. If you want to do some upgrades to your office, client appreciation, lunches or dinners, direct mail, any expense related to your business, we can pay out those marketing reimbursement dollars on. So again, for every $100,000 in premium, $200 in marketing money, and we'll pay 50% of those submitted expenses. If you have any questions, don't hesitate to reach out to us for more information. 1-800-255-5055. Next, our new Producer Builders program. So this is for newly contracted producers with us in the first 180 days of contracting. If you hit that $100,000 in premium level, again, annuity, single premium life, however it comes, we'll take it. We'll either get you a $750 cash bonus, 2-year website service, or the latest generation iPad. If you want to forego that, shoot for the $300,000 premium level in 6 months. You'd qualify for either a Social Security program and 3,000 piece mailing, $2,000 in marketing reimbursement money, as I just mentioned in the previous slide, or a $1,500 Visa gift card. If you want to shoot for the stars and hit that $500,000 premium level in your first 6 months, which is very easy to do. We've had many producers do that in just one case. You'd qualify for a 5,000 piece mailing and seminar coaching with one of our top producers, Matt Gill, a 4,000 piece mailing and seminar coaching with another one of our great producers, Dave Pemper, or a customize your own Ritz Carlton travel package. So again, we want to reward you for coming on with us and reaching some of those production goals in the first 6 months of doing business with us. So again, more information, please don't hesitate to reach out. Just want to highlight our back office support. We truly assist you in every stage of the business process, from, as we like to say, submission to commission. Whether it's case design, getting you out forms for new business or service, quotes, coaching, just going over cases, going over, scenarios and maybe what to to say to a client, or how to share some of the concepts or ideas, to contracting, to tools and resources to help build your business. That's what we're here for. We want to save you time. We actually want to save you money as well. So you can be out there doing what you do best, and that's meeting with your clients and prospects. Also want to talk briefly about our creative marketing team and the solutions that they can assist you with. Josh Trecarton and Tasia Peterson over in the Creative Services Department. Great couple of individuals, extremely talented, and we are just eager to, assist in any way that they can, whether it be business cards, helping you design a logo, stationery, brochures, social media marketing. Actually, we've done a couple of webinars here recently on social media marketing tips and tricks, and most recently we talked about a Facebook business page, how to set it up. What times are good times to post. So just a wealth of again, talent and information in that department. So I would highly encourage you to reach out to our creative services team if they can help. 1-800-255-5055. Just ask for Josh or Tasia. Always encourage you on these webinars to visit us on our website. We've got a newly designed website that'll be up and running here in just a short period of time. But the existing website, just a great tool for online forms. It's open 24/7. So if you're doing business on the weekends, or something pops up after our business hours and you need a service form or an application, you can log on to our website and have full access to our forms library. On the life insurance side, we've got a great term quoter and GUL quoter quote tool, as well as annuity quote tools on the website also. So again, just it's always accessible, great information on there. I really encourage you to go out and check us out on the web, www.iamsinc.com. Our retirement analyzer software is developed by agents for agents, so it's a great fact-finding tool to help you develop a repeatable sales process that leads you naturally to a close. If you would like more information on how you might qualify for a free version of that retirement analyzer software, please reach out to our annuity department. I'd be more than happy to discuss that with you and get you more information out. You can reach any of our annuity marketers at 1-800-255-5055. Back in late January, we launched IAMS Wealth Management, just a move that we thought was imperative with what was coming with the DOL ruling. So we wanted to position ourselves to be there for you, for those of you that are more assets under management focused, Series 65 licensed individuals. We can help with all aspects of your business. So would love to have any one of you introduced to our wealth management team, Charles Hiring Jr. and Mike Hansen. Over there in that department. Great guys, extremely knowledgeable, and really eager to help. If you'd like more information on IAMS Wealth Management, please don't hesitate to reach out. I'm going to launch a quick poll here. If you would like me to put you in contact with one of those gentlemen, just click yes. I'd be more than happy to pass your name along to them. And I'll leave that up for just a couple more seconds here, and we'll keep it moving. Okay, and thanks for all those who clicked yes. I'll be passing your information along. Next, I want to talk about our industry-recognized Life and Annuity Academy. This is an annual academy that that we hold actually a couple times a year. We just had our first one, pardon me, in late May, or excuse me, mid-May, May 17th through the 19th. Just highly attended, great time of just sharing ideas, educating you on the latest industry topics. We discussed business insurance concepts, large life case marketing, wealth transfer opportunities, and the latest news on the annuity side as well. So that trip is completely sponsored by us. So we pay for your airfare out, your lodging, your food, and really use it as an opportunity to kind of pour into you, invest in you, so you can go back and be successful, be armed with some good information. If you'd like more information on how you might be able to attend our Life and Annuity Academy, the next dates are in early September. I believe the 7th through the 9th. I could be a little off on those dates, but we'll have one in September and then another in November. So if you are interested in attending or would like more information, I'm going to launch a quick poll. Just click yes on that poll question, and we'll reach out to you here with more information. A couple more seconds and I'll get that closed out. Thank you. Next, our IAMS 2018 Marketing Summit is February 25th through the 28th in Scottsdale, Arizona at the beautiful Boulders Resort and Spa. So 4 days, 3 nights where we focus on, just education, but it's also a social event as well for our producers out there. So if there's any interest in attending that marketing summit, again, please don't hesitate to reach out to us, 1-800-255-5055, and we can assist you on, some information on how you might get to attend that trip. I want to thank you all for bearing with me on the introductory slides here. Just some great programs that we have for you, for those of you that aren't producers with us or currently contracted with us, some great opportunities there. Again, for more information or if you have any questions, please don't hesitate to reach out. 1-800-255-5055. Visit us on the web, www.iamsinc.com. Again, my name is TJ. You can reach me via email at tj@iamsinc.com. I'm going to go ahead and turn it over to Andy Backegard here, and he'll get started with the presentation.
Thank you, TJ.
No problem. Thank you, Andy.
Bear with me 1 second. All right, so yeah, we want to jump right into things. Thank you so much for the intro and all that great information. I've done a number of these with IAMS and TJ, but I'm always amazed at the opportunities that they'll set in front of you, whether it's opportunities to learn, opportunities to reinvest in your business. It's great working with a partner like that. So, just everybody. Really more so retirement planning, for the small business owner. So we want to take a focus on this. And now obviously the retirement planning concept can really, be for any of your customers, but we're really looking at, the business owner and how this can be a benefit to them. So first and foremost, I want to get our disclosures page out of the way. These disclosures do apply to this presentation in its entirety. If you do want a copy of the presentation, just let your representative at IAMS know, and they'll be able to get you a copy of the presentation sent out. So what are we looking at here? We're looking at a couple. They're probably dreaming about their retirement, and again, in this case, what we want to focus on is how can we help a small business owner with their retirement. There's certainly some roadblocks that could be out there for them. the ERISA guidelines, as far as, what they provide, themselves for retirement. Sometimes there has to be a correlation, on what they provide to their employees. And we're not saying to go promote, pulling all the retirement benefits away from all their employees, but a lot of times small business owners want to do more, and they run out of options. Either they have, income limitations, so they make enough money where they can't contribute to some of the qualified plans that are out there. And again, the ERISA guidelines come into play, and maybe just the expense of setting up an employer sponsored plan is really, just a burden on how the business can operate. So this is a big opportunity, and the types of clients you want are the successful business owners. Nobody's out there saying, I'm just going to try to find the $50 a month premiums and really focus on that. Most people want, some of that higher end business, and this is really a great area to get started with that. And again, if you can find successful business owners, take a look at it, and really once you get going with it, it's going to be easier and easier to have those conversations with other business owners, maybe partners that they have within the business, or even just top level employees, executive bonus type situations. So the agenda for today, we're going to look at a few different areas. We're going to look at why life insurance. Obviously we want to see why we would choose life insurance as a portion of a business owner's retirement plan. We want to look at why North American, maybe some areas that set us apart, some differences that we have within our portfolio that can really help you with the sales process. Then we're going to look at some positioning and presentation, give you some ideas of how this can really benefit your customers. So first and foremost, why life insurance? Obviously, we want to have, during the working years, the income protection for the spouse. That's really the death benefit. And that could be income protection for the spouse. That could be maybe a business continuation plan if there's, kids involved, or they want to make sure they keep the business going. It could be a buyout for a partner. We've looked at along the way a lot of different opportunities. We looked at, buy-sell agreements. We've seen executive bonus, some of those other topics that really hit home with the business owner. This can, really be a combination of a number of different things. When we look at that death benefit, it's generally income tax free. As long as we're setting up those policies correctly, with the right amount of premium, the right, beneficiaries, we can generally guarantee that there's not going to be any income tax on that death benefit. So that's during the working years. Now during the retirement years, what can this offer? It can be a death benefit for the beneficiaries, obviously some legacy building. We can supplement the retirement income. And that's really the big one, is that the life insurance plans of today, the index universal life policies in particular, have some great features where we can help your clients to supplement their retirement income. And then finally, create a legacy. We want to make sure that there's some money left over, if the client wants there to be. So we're going to talk about a couple of features that are built into our products that really give you the opportunity not only to sell your business owner on the retirement income side of things, but also on that ability to create that lasting legacy for their family. So when you look at the client benefits for life insurance, obviously the death benefit protection, first and foremost, for you as the advisor and, for us as the insurance company, we want to make sure that there's a need for life insurance. And I think everyone on the phone has seen all the LIMR stats and, all the different, numbers that are out there. If you're familiar with lifehappens.org, typically, our population is underinsured. We want to make sure that the client, first and foremost, getting the right amount of death benefit protection. And some of the areas we talked about before that were really, that really hit home with the business community is really the limitations that we would have, whether it's through the ERISA guidelines or just through the limitations that the IRS puts on the amount of money that somebody can put into their retirement plans. For business owners, sometimes that creates an issue where they can't put enough away to create the retirement stream, income stream that they would like. So there's no funding limitations on the life insurance policy. As long as we can, justify the death benefit, we can, the clients can basically put as much money as they want into these policies. We're also offering tax deferred growth. This is a great thing. And that's one of the big downfalls of, once we've maxed out all the options that we have as far as retirement planning goes, a lot of times our options are accounts that are going to be 1099 type accounts. So this gives you the opportunity to offer tax deferred growth on the money for your client. The tax-free income is really, one of the biggest selling points that we would have within a life insurance policy. That ability for them to take that money out via loans in a tax preferred basis is a really, again, probably the main selling point that you're going to make to your clients. No penalties, and we're talking about early withdrawal penalties. If they have a great run in their business and they are able to retire at age 55, we're not limiting the money they can pull out. It's still going to have that tax preferred basis. No required minimum distributions. We're not in the life insurance industry going to force your clients to take money out, even if they don't want to. So we have our traditional retirement plans, our IRAs, those types of things. Client hits 70 and a half, they are being forced to pull money out. Maybe that's something that they don't want to do. On the life insurance side especially, if they don't need to pull those funds out, they have that tax-free death benefit that's going to go to the beneficiary. So there might be situations where the thought process was, we may need this later on, but at the time, they end up not needing it. So there's not going to be any kind of forced distributions from the policy. Some considerations, and we talked a little bit about this before, but make sure the death benefit needs are met. Do a death benefit needs analysis. Make sure that first and foremost, you're getting them the correct amount of death benefit. Now, that doesn't necessarily mean that we have to solve for the IUL to meet 100% of their death benefit needs. If the most efficient way to run the life insurance policy is to lower the IUL policy is to lower the death benefit down a little bit so we can maximize what they're going to get as far as performance goes, maybe there's an opportunity for a second sale, a GUL or a term policy, to make sure that you have met the needs of the client as far as the life insurance goes. And maybe that life insurance need is going to be temporary. They have young kids or the business is just starting and they have some debt. That's the opportunity there to make sure that the death benefit needs are met and in a cost-effective way for the client. Other considerations, these are non-guaranteed performance. We do have guarantees built into the contract. We're going to talk a little bit about those, but generally speaking, what we're looking at is an illustrated situation. So if we're using look-backs and we're using different interest rates as far as what the variable loans are going to perform at, that's non-guaranteed performance. Now, obviously, we want to do something that the client's comfortable with. So we really want to just have that conversation with them and see what interest rates are comfortable for them, show them all the look-backs and the different performances of the different indexes, and really, let them be a part of that decision. Obviously, this is life insurance, so there's going to be insurance charges. And that's, one thing to consider is that not only are you dumping money in for that retirement income, but you're also paying for a death benefit. And that's an important part of these sales, but there will be insurance charges that would come out of the contract to cover those death benefits. And then finally, surrender charges. There's going to be surrender charges on most of these contracts. We do have some options where you can waive surrender charges, but in our examples today, we're going to look at situations where there would be some surrender charges in the early years of the contract. Another consideration, again, make sure we have the right amount of death benefit, and if that requires you to supplement with a little bit of term or a little bit of GUL, make sure again you're hitting the coverage needs of the client. Specified amount of coverage. We want to make sure that the amount of coverage that we are specifying is appropriate for the amount of premium going in. So there's options here where if the client maybe wants to do a little more premium, we can certainly bump up the death benefit amount. If there's situations where there's going to be expected changes in premium, we need to make sure that we solve for an appropriate amount of death benefit. So when we start out, if we're doing $500 a month and the client wants to continue to increase their premiums as they move forward, which most people do, typically you don't see somebody that's 30 years old, putting the same amount of money in when they're 50. Usually as you're getting raises, as you're, again, in this situation, the business is more profitable. There may be more money to put into life policy. So we want to make sure that we solve for that. And there's, some different things that we can do. One way we can do that is with an increasing death benefit option. So what that's going to do is allow us to solve for a lower death benefit up front, and maybe adding a little more premium in. So we want to make sure that we look at both situations. If the level death benefit's appropriate, we want to go that way. But if an increasing death benefit option allows them to add additional premiums to the policy, and we structure it properly, then we may have an opportunity there for a little higher distributions coming out of the contract. Modified endowment contract. There are some situations, when we're talking about single premiums and, a few of the concepts that we promote pretty heavily here at North American, where a modified endowment contract is just going to happen because of the premium that's going into the contract up front. In these situations with the retirement planning, we want to make sure that we avoid the modified endowment contract. And again, that's just all planning up front. We want to make sure we're planning for premium increases. We want to make sure we're planning for the appropriate amount of death benefit coverage. And the modified endowment contract is going to have some negative implications on the loans coming out of the contract. So again, we want to avoid that. And for us here at North American, which is a little different from some carriers, we'll not only tell you is it going to be a MEC at the time of issue, but based on the amount of premium going in, the increases in premium, the death benefit changes, will it become a modified endowment later? So you want to really look at the wording when you're running these illustrations. Some say this contract is not a modified endowment at the time of issue. It doesn't mean it's not going to be, if you make some of the future changes down the road. Lump sums and transfers. If we have a 1035 coming in, it's not a big deal. But if the client wants to do a lump sum into the contract, we have some options where they can actually put money into a SPIA, and then we can fund the life insurance policy through the SPIA. Typically a lump sum is either going to create a really high death benefit up front, which is going to be hard to maintain if we don't continue to put premiums in, or there's going to be situations where maybe there's more premium than we'll allow. So we want to make sure that we have an option for that, so we can spread those premiums out, make sure the contract is not a MEC, and create that retirement distribution for the client. So now the second item is going to be, why North American company? What makes us different? What are some different features that we have that can help you, again, during the sales process to solidify some of these sales? So the product that we're going to look at today is our Builder IUL. Some of the unique features that we have would be daily index sweeps. If the market's open and the client pays a premium, we're going to sweep that money into the account. Now, that might sound just like a logical thing to do. You pay your premium, it should get credited to the indexes that you want. But with some carriers, they're doing weekly sweeps. Some are monthly, some are quarterly. If you think about a quarterly sweep, client pays premium today. The quarterly sweep was yesterday. They would have to wait 3 full months before that premium actually gets into the index bucket. So they have 3 months where they're going to sit in a low interest-bearing fixed account. So when one of your customers buys an index policy, their intention is probably that they're going to get index credits when they pay their premiums. In a situation that could be more delayed than what they think. The second point here is that at North American, we credit interest based on the beginning of the segment value. So that means is that just like all the other carriers, we take expenses and charges out of the policy on a monthly basis. But instead of crediting based on the end of the year value, we go back to the beginning of the segment and we credit based on that. So in an example, if you have $10,000 and there's $1,000 worth of charges that come out throughout the year, most carriers are going to give you your index credit based on the $9,000 that's left over at the end of the year. We're actually going to credit your interest based on the original $10,000. So again, that's maybe it doesn't sound like a lot today, but if we project that out over a number of years, that's a huge benefit for you. So now if we have a 10% gain, let's say company A is crediting 900, North American is going to credit 1,000. So again, just another unique design feature that really enhances the performance and the opportunities for the customer. We also don't require any funds to be in the fixed account. So we're not going to tell your clients that based on the amount of premium you have and the crediting strategies you select, this percentage is going to be in a fixed account. And that's, again, that intention of the client. They can certainly put as much of their premium as they want in the fixed account. But again, when you buy an index policy, typically you're looking for that upside potential of the indexed account. And when we require that you put money in the fixed account, you're taking away a little of that potential upside. And a lot of it has to do with them. They're putting the money in the fixed account to cover those monthly expenses, and we're not going to require you to do that because of how we credit interest. So that's another just positive thing that you can talk with your clients about. We also have a variable loan rate, and we have it capped. So when we look at these types of policies, and the biggest driving force behind the performance on these contracts is, what are you paying to get your money out? These are situations where we're not necessarily taking withdrawals in most cases. We're actually taking a loan from the policy. So, in this situation, we have a capped variable loan rate, and current rates, are fairly low. We have, pretty conservative rates right now as far as what we're paying to borrow money. But that number can fluctuate. It's a variable loan, so it can move. What we've done is we've capped our variable loan at 6%. So in a lot of situations, I'll advise you as the agent to actually run the loan at the cap rate. We talked about the moving parts. The caps can change. The different things that can change within an IUL policy. If you can show the client, we're really showing you the worst case scenario on this loan rate. That's certainly positive. We also have an overloan protection, and if you're selling index universal life policies, this is a pretty common feature. Basically, just doesn't allow you to take too much out of the policy. We're going to cause the policy to lapse, and then you'll have some negative tax consequences for the client, and that's pretty standard. There's some companies that maybe don't have it, but I would say the majority of the companies that you're selling would have an overloan protection. The different feature that we have is protected death benefit, and we talk about the idea of not only creating that retirement income for the client, but also that legacy. So in this situation, and this is an optional benefit, it's going to be included automatically on the policy. It's something that you decide on at the time. So when you start taking loans out, you would make the decision, do I want to have the overloan protection or the protected death benefit? So you don't have to make the decision today. You can make it in the future. Basically, what the protected death benefit does is it allows your clients to carve out a chunk of the death benefit. If they have $1 million policy, they can take $250,000, kind of set it off to the side, take some of the cash value and buy up a guaranteed death benefit contract or a policy. So you'd have $250,000 of guaranteed death benefit. You would take your loans based on the remaining death benefit and the remaining cash value. So now if something happens, you're going to take your loans, something happens to you, instead of just getting the small amount of death benefit that might be left over with the overloan protection benefit, they're going to have a $250,000 guaranteed policy. That's going to be something that's going to go to the beneficiaries no matter what. So it gives them, again, just a little more flexibility. You don't have to use it. Certainly some people are going to say, not that I don't care about my beneficiaries, but I need as much out of this policy as I can get for my own retirement, for my own income stream. And some people are going to say, I want to make sure a chunk of this goes to my kids, my grandkids. Maybe in this situation, it's a business partner, and you have some kind of arrangement there for a delayed buyout or something like that. But this gives them the flexibility and the opportunity to make some of those decisions. Not today, at age 30, 35, 40, whatever the age is, but you can make that decision at age 65 or whenever the client plans to retire. So again, just some additional unique features. Interest rate bonus. This has become a really hot topic within the industry. So when we talk about interest rate bonuses, there's many different ways that carriers can apply interest rate bonuses to a contract. For us, we've made the decision to make it a guaranteed interest rate bonus. So, what some carriers will do is they'll, have some kind of a factor that if this and this and this happens, we're going to pay you this interest rate bonus. So there's other, variables that come into play, a little less predictable. and a lot of times it's based on previous year's performance. So what we know about our illustrations is that they're showing just a steady interest rate. So if you're illustrating at 6%, it's just 6% per year, like clockwork. Well, we all know on the phone that that is not, necessarily a reality. You're not going to just get exactly 6% every year, for the entire time you have the contract. It's going to fluctuate. You're going to cap out some years. You're going to get, a 0% return some years with the 0% floor, and everywhere in between. So we want to, again, make sure that that interest rate bonus isn't something that's predicated on, other things happening. So we've made ours guaranteed. It's 0.75%, starts in year 11, and it's going to be guaranteed. That bonus goes through the caps. It would be added to the floor. So if you end up getting a 12% return, we're going to credit 12.75%. If you get a 0% return, we're going to credit you 0.75. So it's something that's going to be there on a guaranteed basis. We also have a 2.5% minimum account value. What we really do is we call this our true up rate. So, what this does is it gives the client a true worst case scenario. If something happens, early on where they maybe had a couple of years of no returns, and then they surrender the contract or they die, something happens, we're going to go back and make sure that they've earned at least 2.5%, as a minimum guarantee. The true up happens every 10 years. We're going to look at the account value, and we're going to look at what the true up value, the 2.5% minimum account value, looks like. And whichever one is higher, that's what we're going to now reset the account value to. So, in a lot of situations, it won't come into play, but it gives the client, again, that minimum guaranteed account value that they can count on. Gives them some guarantees built into the contract. We're also going to look at the accelerated death benefits, and this is a big, again, talking point. We've got a lot of information going around with with the healthcare plans and things like that, and that's all kind of the government doing their work to try to make a plan that works for everyone. What we have is some just additional benefits that can help with some of the more catastrophic situations. So we have a terminal illness benefit, we have a chronic illness benefit, and then we have a critical illness benefit. So with these benefits, we're not doing any additional upfront underwriting. We're not charging any premium. With this, the terminal illness benefit, we have a 24-month life expectancy. Our minimum acceleration amount is going to be the lesser of 10% of the death benefit, or $100,000, and the maximum amount that can be accelerated is a lesser of 75% of the death benefit, or $750,000. When we think about the terminal illness benefit, a lot of times it's a situation where we want to make sure that the client isn't life insurance rich, cash poor. So with terminal illness, there's obviously, maybe that is a situation where they have to, quit working. Well, the business that they own at that point can suffer. Accelerating that death benefit could be a way for them to, infuse some cash into the business and make sure that, things continue to run. It can be a way for them to, set up that succession plan. We've talked about that before. Maybe they want to be a part of that process and waiting for the death benefit to pay out. Obviously, they will not have a say, as much in where that those monies go and how that succession planning works out. There also just could be a situation where they don't want to, or they want to see what their kids or their beneficiaries or their business partners going to do with that money. So it gives them that opportunity to, while they're living, to really see their family experience that death benefit, those proceeds, and give them an idea of what they're going to do. Maybe it's just taking the family on a trip. So the critical illness, again, we have no additional upfront premium costs or underwriting. When we look at the different medical conditions, it's a heart attack, different types of cancer, stroke, organ transplant, kidney failure. There's a lot of different medical conditions. Basically, what happens with the minimums and maximums, the maximum amount that can be accelerated per critical illness occurrence is a lesser of 25% of the face amount, or $50,000. The minimum amount available is $2,500 in death benefit accelerated. So some of the carriers out there and a lot of the different critical illness policies are basically underwritten up front and then re-underwritten at the time of claim to see what the benefit's going to look like. with us, we've created a known accelerated amount. And basically what we're saying is that instead of having to go through underwriting again to see what's the severity of the illness, are we, kind of confirming everything, which can take, weeks, months, it can take a while. We want to make sure the client gets paid out right away. So we're going to be paying 40% of the amount accelerated. So they're going to receive 40 cents on every dollar that they accelerate, which really gives them the ability to know up front. Typically if I, have a heart attack and I'm away from work for, a month, 2 months, whatever it may be, maybe I don't have the PTO or I don't have a short-term disability plan, through my work. I'm going to need some money up front just to get my family through. Maybe there's travel expenses for the, going to the hospitals if you live in a rural area, whatever that may look like for you as a client. But what we're doing is we're providing that benefit right away. So instead of having to take, a month, 2 months to get, re-underwritten and kind of figure out what amount we're going to pay, we're going to pay it out, and we know the dollar amount, so we can get the doctor's certification and literally pay it out right away. So it's really just, it creates a better turnaround time. We mentioned a number of different things that this could be good for, whether it's, providing, income. Again, this could be a situation, for a business owner where they're taken away from the business. That could be a detriment to how the business runs. Maybe there's, the ability to hire some temp workers or something to cover some of those expenses. So this just, again, gives a lot of different flexibility. The other one is chronic illness. Again, we do no additional upfront premium costs or underwriting, so we're not charging the client anything additional in premium. When we look at the qualifying conditions, it's somebody that's unable to perform 2 out of the 6 activities of daily living, or is deemed to be cognitively impaired. So this is again, it's similar to requirements to be for nursing home care or long-term care insurance. Gives the client a lot of different flexibility. Now, for this, when we look at the minimum and maximum amounts that can be accelerated, the minimum acceleration is 5% of the initial death benefit. The maximum benefit available is 24% of the initial death benefit at the time of election, or up to $240,000 with one election available every 12 months. So the total acceleration that we can offer is up to 95% of the death benefit. We do require that there is a residual death benefit, which would be the greater of 5% of the death benefit on the initial election date, or $10,000, whichever one is greater. What you'll see is that the top bullet, we don't require any additional upfront premium costs or underwriting. What we do for this is we discount the amount of acceleration on the back end. So depending on the amount of cash value and the age of the client, we're going to look at what's the life expectancy for a chronically ill 70-year-old, and maybe that's 3% or 3 years. We're going to then do that calculation based on the life expectancy and what our opportunity costs would be as a company. The idea is for us to basically break even. So we're not trying to profit from this, but we also want to make sure that we can offer the benefit to the client. So the discounted death benefit roughly is going to equal about the percentage of the client's age. So if they're 80 and they accelerate $100,000, they'll get roughly $80,000. That's again going to depend on the amount of cash value in the policy, a couple of different factors. One thing that we offer that you can actually show to your clients is we have what's called our changing needs report. It's going to do an analysis of some different ages, and it's going to show you what the projected payouts would look like based on the cash value and the buildup within the policy. So you can certainly add that report, or if you're requesting illustrations from IAMS, they'll be able to run those numbers for you. To me, the marketability here is pretty much endless. It's an opportunity for the client to accelerate their benefits. In case of they need to go into a nursing home, they need to retrofit their home, maybe even their office, whatever the situation may be. But this gives them the opportunity to get at that death benefit prior to dying. And we know, and you've probably seen it, is that somebody can be chronically ill and live for a long time. There's situations where people are in nursing homes, or they have home care coming in for extended periods of time. You don't have to accelerate the full 24%. If you don't need $240,000 a year out of your $1 million policy, accelerate the minimum. 5%, 10%, whatever the needs are for the client. And that gives them, a sustained, a longer term benefit that they can get at. So definitely, an opportunity there, a great, sales opportunity. I really consider the accelerated benefits, a great, oh, by the way, it might not be your main selling point, but you come back with, oh, by the way, on top of all these other benefits, the death benefit, the retirement income, you also have these living benefits that you can get at some of this money in case of a terminal illness, a chronic illness, or a critical illness. It's going to create some additional talking points and really put you in a position where you can just solidify that sale, really, fill any holes that might be in there for the client. So we want to, tailor and maintain the policy as well. So we want to make sure that we're selecting the correct death benefit option, level or increasing death benefit. We want to make sure that we're running the correct solves. So whether it's guideline premium test or cash value accumulation test, for the most part, we're going to be running a guideline premium test. There might be a random scenario where cash value accumulation test comes into play, but for the most part, guideline premium test is going to be the option that we use when we're talking about retirement planning. Standard loans versus variable interest rate loans. We talked a little bit about the variable interest rate loans and how we have a cap, but at the same time, there's opportunities where maybe a client wants to be a little more conservative, and a standard loan makes more sense. Certainly, have that conversation with the client, show them the options. They can switch from loan types with North American without paying off the previous loan, so they have a little more flexibility there than they would with most companies. But again, depending on their level of comfort with the variable interest rate versus just the fixed rates, we have opportunities for both sides of things there, and we're going to look at both of those in the sample illustrations. And then maintenance. A big part of these is getting back in touch with the client, doing some client review and policy review. You want to make sure that the changes that they made, or if we're going from increasing to level, or whatever the situation may be, is that those things are actually happening. If you've planned increases in premium, we're not going to automatically draw more money out of their account. Client has to call in. And that's a perfect opportunity for you to get out and meet with the client, make sure that they're still in the same situation they were in when they bought the policy, that they're actually putting those additional funds in. Maybe the business is really taken off and they want to do some additional funding, or maybe they have some key employees that they would like to do this funding on. It's a really good opportunity to get back with that business owner and get some face time. So definitely think about that maintenance as not only just doing your job, but also as a potential opportunity for an additional sale, or for a bump up in the premium, some of those additional opportunities that are out there. So finally, the third item on our agenda, we're going to look at positioning and presentation. So we're going to look at some different markets that would be a good fit for this. So the target markets, again, we're kind of hammering this home, but a need for death benefit protection, and make sure the clients have a need for death benefit. Somebody that's planning for retirement, and most business owners certainly would be planning for retirement. Now, part of that retirement might be the ability to sell their business and get a lump sum, but maybe there's a situation where they want to have some additional retirement funds in place on top of what they're already doing, and again just some tax preferred money that they can have access to. Maybe they lack access to a qualified plan. In this situation, it might be more of a situation where the qualified plan is kind of cost prohibitive. So there's potential costs that are going to be detrimental to the business, so they don't want to offer the qualified plan. And that's really a lot of that comes back to the ERISA guidelines, and what if they offer themselves a plan, they also have to offer it to their employees. And then concerned about market risk exposure. This is a big concern, and we've seen the market's been pretty steadily going up. Are there going to be corrections? We don't know. We can't predict that. So we want to put some plans in place that can help us to really mitigate some of that risk that would be out there as far as that market risk to the clients. So we're going to look at a business owner. He owns a restaurant, 45-year-old. This is a case study on Alan. He's a preferred non-tobacco rate. He needs death benefit protection. He's got $20,000 for 20 years. So this is a situation where we want to look at, a retirement planning case, in a real life scenario. So here's the income planning with a variable interest rate loan. So we've got our set amount of premium going in. We've solved it for a level death benefit. Got over $1 million in coverage, so we've met the need of the business owner as far as the amount of death benefit coverage we need. We knew he had $20,000 in premium, so it's a fairly simple solve. We just solved for the minimum death benefit to meet the maximum distribution amount, and what we've come up with is $66,057 of distribution coming out of the policy in the form of a variable interest rate loan. So that's the one option. Now we talked a little bit about the idea that maybe they don't always want to do the variable interest rate loan. What's the difference if we look at a standard loan? Now we're not going to get too deep into this, but with a variable loan, obviously we can create some positive arbitrage where the interest rate is higher than the loan rate we're charging. There's a positive interest effect on the cash value that remains in the policy. So we can see a little higher loan value. If we run a net zero cost loan, we're not having that positive arbitrage. We're paying the same for the money that you're borrowing as what you're going to get credited. So it's got a net zero cost effect. So that loan amount drops. It gives the client probably a more stable, a little more predictable income that drops from $66,000 down to $50,000. So there's an effect on the amount of income, but again, we have put the client in a strong position. Still have over $1 million in death benefit. We have $50,280 of distribution that can come out of the policy. So if we want to look at more of a death benefit illustration, and we want to figure out just, the client needs a certain amount of distribution. So he wants just $60,000 in distribution. What is the death benefit and the premium that would be necessary to get that distribution right at $60,000? So based on our illustrator rate of 7%, we would need about $987,000 in death benefit and about $18,500 in premium. That's going to get us to our $60,000. So again, we can back into these as well and really tailor fit these plans for the client. Sometimes getting maybe they have a certain amount of premium and getting the absolute maximum distribution out of the contract isn't the most important thing. I think we always assume that they would want, as much distribution as possible. It could be a situation where they want to have the death benefit. They want to, they know the amount of premium they can afford. Maybe they only need $30,000 in this situation. Well, what's going to happen is the surrender values, the account values, the death benefit's going to remain, at a higher level. So, that's just the maximum amount of distribution might not always be the only thing the client's looking for. And we really want to look at how we get to that number. Again, we talked about the beginning of the segment interest crediting. We talked about the guaranteed interest rate bonus. It's going to be kicking in, in this contract in year 11. The capped variable loans, all those different features. Make sure when you're looking at your carriers, and I know you have access to more than just North American, make sure you're looking at all those different things. And, what are the moving parts within a contract, and, what are the likelihood of these things happening? We certainly can't predict all of that, with 100% certainty, but the more guarantees and, fixed portions of a contract that there are, the more likely it's going to happen. So we have 75 basis point guaranteed interest rate bonus. That's more likely to happen than, some kind of hypothetical number that's out there based on past performance or future performance or whatever, credited a bonus in the last 10 years of premiums. With this, we're again, you're just giving the client a little more stability. Also the capped variable loans. If we have uncapped variable loans in the Moody's bond rate, shoots up, we have some hyperinflation or something, we would probably see a negative effect on that loan rate. Maybe it jumps to 8, 9, 10. Well, it's going to be a whole lot different than the 6 that we ran it at. So again, just some things to consider and be asking those questions, of your marketers at IAMS, of your clients, see what they're comfortable with. If they'd rather have, a kind of a worst case scenario, make sure that you're looking at, carriers that have guarantees built into their plans. So another way to look at this is with an INSMARC illustration. If you're not familiar with INSMARC, we're actually going to be doing a national webinar on Thursday on the INSMARC software. But basically what it does is it compares alternative investment options with the life insurance plan. So if we look at this situation and we, compare what would in this situation, a tax-deductible retirement plan look like versus what we're doing with the life insurance premium. So these are the tax-deductible deposits to the TDRP compared to the policy premium and the distributions. So what we'll see is that we have a situation where, at age 96 in this case, the client's going to run out of money in the tax-deductible retirement plan versus a life insurance policy running out all the way to age 100. Now, another key benefit here is that we have the life insurance policy. So we're not only getting the policy loan proceeds, but we have a great death benefit as well. So something to look at, it's a scenario where, sometimes the 30-page life insurance illustration, although it's necessary, is a little, cumbersome and not the greatest thing to be presenting, to a client. So although we're not going to be able to get rid of the 30-page life insurance illustration, if we do have the opportunity to show some third-party material, that would be, the time to really, again, just solidify that sale, kind of put that final nail in the presentation. So we also have marketing pieces. We have financial objectives discussion guides. So this is something that where you can collect some financial information from the client, really get an idea of what their goals are. If it's to sell their business at a certain time, if it's to expand, to additional locations, what is the outlook? What is the goal for the client? Gets you a little more, attuned to what they're doing. We have case studies. We have all kinds of different materials. You can find this in print format, and we also have a marketing landing page where you can get all this information. And we'll send a follow-up email with some of those links and the information at the after the call today. So when we look at the summary, we looked at why life insurance. Especially for a business owner, we're not only planning for the present and the future, but we'll also beyond. We want to make sure that we not only have them covered today if something happens, in the short term, but also that future, which would be the retirement planning, and then beyond, which would be the legacy building that we can do with the family or the business. And why North American company? Really, the key is that there's a lot of different options in the industry. We want to make sure that our products are sustainable, that we're looking long term. We're not, trying to buy business up front. So we want to make sure we have a product that is very competitive for the client, pays you a good commission. It has some of the values that you would want, whether it's the accelerated benefits, the some of the guarantees within the contract. So all those different things all piled into one product, that creates a competitive option for you to sell, and something that you're going to come back to the client and be able to hold your head high when you're looking at enforced illustrations and things like that. And then positioning and presenting, we looked at a sample case on Alan, who's the restaurant owner, and just show you some different ways that you can run those distribution reports. And it's not always about just taking the maximum amount of premium and buying the maximum amount of death benefit and getting the maximum distribution. That could be the case, and a lot of clients, that's what they're going to want to see. But there's also scenarios where, we've kind of mix and match some of those values and just create the most competitive and most tailor fit situation for your clients. So the bottom line, the client gets their death benefit protection during the working years. They have the opportunity for that cash value accumulation to help with the retirement income, and the ability with the protected death benefit, or with in a smaller sense with the overloan protection, the ability to create that legacy. You get an opportunity to get in front of business owners and clients in general, but for what we're talking about today, the business owners, this is a huge opportunity for them. And then all the supporting materials, obviously your best go-to is the staff at IAMS. They're fantastic. They'll be able to help you out if there's situations where the case gets a little sticky and the illustrations need to be run. They certainly have access to me, and you as advisors would also be able to give me a call, or I can reach out to you and we can have some of these conversations maybe on more specific clients. So what I would say is think about the business owners that you're currently working with, whether it's if you're doing some other financial planning for them, if you're doing their business insurance, their property and casualty type insurance, create that list and start to reach out to them and make sure that they have the appropriate retirement plans in place. A lot of times business owners are so focused on making the business successful and worrying about their employees and all those different things, they sometimes forget about their own future financial needs. And if their retirement plan is just, well, I'm going to sell the business, well, that maybe there's some safety nets that you can put in place, some help that you can be to them to make sure that not only do they have that buyout option, but they also have some additional funds that they would be able to have access to. So with that, I'm gonna turn things back over to TJ, and if there's any questions, we can certainly address those at this time. TJ, are you on?
Yep, sorry about that. I got hit the
Oh,
wrong button.
no problem. So I don't know, are you seeing any questions out there?
Just get them opened up here. You know what? I don't have any right now. If you do have any questions, go ahead and type them in the box there. But yeah, nope, Andy, don't see anything as of yet. And maybe while we're waiting, Andy, can you go over on the chronic illness,
Mm-hmm.
The accelerated death benefit there? You had mentioned the max was 24% up to 250,000. Is that correct?
Yeah, 240,000. Yes.
240,000. And then you mentioned something about like 95% of the death benefit could be accelerated.
Right. So if you look at this, if you go 24%, let's say just to make round numbers, if you have a $100,000 death benefit and you take 24% out per year, your first 3 years you're going to be able to get the full 24,000. The final year you're only going to be able to get 23,000 basically, because it's going to be only be able to get to 95% of the overall death benefit. So the idea is that a lot of situations clients might not need that whole amount. So if they start taking 10% out, they're going to be able to take 10% out for 9.5 years, or however the whatever the numbers kind of play out to be. But you can stretch that out even further. You don't have to max out the benefit. You can take the minimum amount. The nice part about that is that there's some benefits. If once you accelerate over 50%, we're going to suspend lapse checking, so there's not going to be the opportunity for the policy to lapse. So the client, at that point, wouldn't have to continue to pay premiums if they didn't want to into the contract. So there's some definite benefits to utilizing the accelerations, even if it's on a smaller basis, maybe not the full maximum distribution. So yeah, that's basically just the percentage of death benefit will allow you to accelerate is up to that 95%.
Gotcha. Okay. Perfect. I appreciate you explaining that in a little more detail. Yeah, no further questions, Andy, and for those on, just want to give Andy a quick shout out in that just a great resource. North American has, it's my opinion, one of the best just IUL suite of products in the marketplace today. And as Andy mentioned, some unique things that they do, in regards to the protected death benefit, that cap variable loan rate. Andy was just educating me personally last week on some of those things, and just so some great things that really make North American stand out, on their life insurance products and in the IUL space. If you'd like more contracting information for North American, if you're not yet contracted with them, please don't hesitate to reach out. I just launched a poll question here. If you'd like, information on how to contract with North American. I can get that out to you. But again, Andy is just a great resource. Has told me on multiple occasions that, if we have any of our producers that would like to speak with him directly, so that he can answer questions, he's more than happy to do that. Just kind of talk over cases, help with case design. So I can't say enough how great of a resource he's been to me and to insurance agency marketing services. So if you'd like to, visit with Andy, I can get your information over to him, and he'd be more than happy to help in any way that he could. So appreciate those that expressed interest in getting contracting information with North American. One of the other topics that we kind of promote here at Insurance Agency Marketing on the life insurance side is single premium life as a great annuity alternative. So if you do have any interest in single premium life, please let us know. We'd be more than happy to get you out, some additional information on that as well. And speaking of which, North American is kind of launching some solutions in that space, and has developing a great product there. So if you'd like more information on that, again, please don't hesitate to reach out, 1-800-255-5055. Would love to get you some information out on single premium life. I want to thank Andy for joining us and just educating us today. Some very helpful information. I've got a couple pages of notes myself, and look forward to us getting back together with Andy again. Want to thank all of you as well for taking time out on your Monday morning to join us. Hope the information was beneficial to you. I will be reaching out just to touch base to see if there are any questions you have for me, or if I can help you with a case. Be more than happy to do so. Again, my name is TJ with Insurance Agency Marketing Services, one of the life marketing directors here. You can reach me at 1-800-255-5055 or via email at tj@iamsinc.com. Thank you, Andy, and thanks for everybody. Thanks everybody for joining.
Thank you, TJ.
Take care. We'll talk to you soon, Andy.
Bye-bye.
Bye-bye.